now we are going to take up this case study on ratio analysis. A very interesting case study, easy one. Seems to be a big one, but yes, very interesting and going to test your basics. That is the most important thing. So let's see what this case study holds for us. RNOC Limited is a listed company and has been facing a cash crunch situation since a while. The CFO is of the opinion that excess stock maintained as per the instructions of the management of the company is the reason for cash crunch. Now the CFO says that you have lot of investment done in the stock. There is a lot of stock that you are keeping in the store. It is as per the instructions of the management because the stock is there, so amount is invested in the stock, you are not recovering that amount easily, so that is a cash crunch situation. However, the management states that its product line requires the larger amount of inventory due to the greater variety of product line, and the customer may ask for any type of product. Now the management says, sir, we have to keep the stock. What if the customer comes? We have number of product lines. What if the customer comes and we do not have the stock of it? So we have to keep a stock. There is no option regarding that. To maintain the competitive advantage, the company should be able to cater to the customer needs as and when required. The management is highly critical of the collection team as the management feels that they are not collecting the receivables within the time as per the industry standards. Now the management says the problem is with the collection team. They are not collecting the receivables in time. That is the major problem. You have been hired by the company as a financial consultant. The management has provided you with the latest audited financial statements and also the relevant industry statistics. You are required to advise the company to improve its liquidity position. Now they have given you the financials. Sales 1 crore 25 lakh, cost of goods sold, that is opening stock plus purchases minus plus expenses minus closing stock. So this is what, this is your COGS, right? This is the value of your COGS. Then operating expenses consisting of administrative expenses and selling and distribution expenses. You will get your operating profit, add non-operating income less non-operating expenses, profit before interest and taxes. That is your EBIT, right? Then less interest, profit before tax, minus taxes, profit after tax. So it is the normal trading and profit and loss account that is given to you. There is nothing special items which are there. The normal trading and profit and loss account which is given. Then you have the balance sheet which is given. The balance sheet consisting of equity share capital, reserves and surplus, then borrowed funds, secured loan, unsecured loan, application of funds, that is the non-current asset. This is your fixed assets. These are what? These are the fixed assets which are given to you. Fine, sir. After that, you have your current assets, that is inventory, receivables, short-term investments, and cash and bank. Less current liabilities, creditors, and short-term loans. Total funds employed. So it is the balance sheet given to you, right? What is your share capital? What are your reserves? What is your long-term debt? All these things are given to you. Then industry standards are given, that is receivable turnover is 90 days. That is in how many days what is the industry standard? As per the industry standard, they collect the money from receivables in 90 days. Okay. Inventory turnover is 100 days. That is in 100 days they convert their inventory into finished goods, they sell the goods and they collect the money from debtors. Right. That is converting inventory into sales. That is what is our inventory turnover ratio. And I told you, whenever we are talking about inventory turnover ratio, we are talking about what? We are talking about finished goods. Right. Then you have the payables turnover ratio, that 90 days you pay the money to your creditors. Net asset turnover ratio is 4 times. Next, they says the company has set certain standards for the upcoming year financial status. All the ratios are based on the closing figures in the financial books, right? So wherever the average is required, you will not take the average. What you will take is you will take the closing figures in the books. Now this information is regarding what? This information is regarding next year, what they are predicting. So this is regarding the next year predictions, next year standards we can say, right? Equity share capital to reserves 1, net profit ratio 15%, gross profit ratio 50%, long-term debt to equity 0.5, debtors turnover 100 days, creditors turnover based on COGS 100 days, inventory 70% of opening inventory, right? Inventory here means the closing inventory. This is which one? This is, they are talking about the closing inventory. That closing inventory will be how much? It will be 70% of the opening inventory. Cash balance is assumed to remain same for the next year. The same cash balance you will maintain in the next year also. Now he says, what is the inventory turnover ratio in days and whether the assertion of CFO is correct. What was the assertion of CFO? That on the management's demand, there is a huge stock that is kept, because of which there is a cash crunch situation. Now we have to calculate inventory turnover ratio in days, not times. Basically what they are asking for is, they are asking to you, that is calculate the inventory holding period, right? Inventory holding period. This is what you need to calculate, sir. Right. Now, how will you calculate, sir? First, calculate the inventory turnover ratio in times. How will you calculate the inventory turnover ratio in times? Let's try to understand. What is inventory turnover ratio? Inventory turnover ratio is COGS divided by average inventory. No, sir. Here we will not take the average inventory, because the question has specifically mentioned that you have to take all the closing figures, right? So here we can take COGS divided by closing inventory. Do you have the value of COGS? Yes, sir. COGS value is, we are having, that is 76 lakh 40,000. Do you have the value of closing inventory? Yes, sir. We have the value of closing inventory, that comes out to 38 lakh 60,000. So ITR will be what? COGS of 76 lakh 40,000 divided by closing inventory of 38 lakh 60,000. So this ITR will be 1 point, how much? 98 times. Let me check. 76 lakh 40,000 divided by 38 lakh 60,000. That comes to correct 1.98 times. 1.98 times. That in the whole year you convert your inventory almost 2 times. That is 1.98 times you convert your inventory into sales. But they are asking for the days, right? So how will you calculate the inventory turnover ratio in days? In days it will be 365 days. 365 days divided by 1.98. Inventory holding period normally that we calculate, divided by 1.98, that comes to roughly 185 days. That comes to roughly 185 days. Do we have the answer 185 days? Yes, sir. 185 days is correct. Now, whether the assertion of CFO is correct or not. Yes, sir. The assertion of CFO is correct. How can we say that it is correct? See here. For the industry, the inventory turnover is 100 days. The industry converts its inventory into sales in 100 days, whereas this company is taking 185 days. So CFO was correct that we are holding the inventory for the longer period, for more number of days we are holding the inventory, because of which there is a cash crunch situation. Is that clear? Everyone, is that clear with this? So this is the first part, that is the inventory turnover ratio. In days we are calculating. In days means we are indirectly calculating what? We are indirectly calculating our inventory holding period. Inventory holding period. Right? Inventory holding period means for how many days we hold the inventory before it is being converted into sales. Now, the second part, second MCQ says, what is the receivable turnover and whether the assertion of management is correct. Now, the management was saying the problem is with the collection of the receivables, right? The collection team is not efficient. They are not collecting the receivables in time. So that is what we have seen, the receivables turnover ratio, or what we call it as the average collection period that we have studied in receivables management, right? So we have to calculate what? The average collection period. How do you calculate the average collection period? That is receivables, the closing receivables here will take, divided by sales per day, divided by 365, right? So the value of closing receivables is given, that is 39 lakh 97,000. Correct, sir. 39 lakh 97,000 divided by sales are given 1 crore 25 lakhs, divided by 365 days, right? Divided by 365 days. So this will give you roughly 117 days. 117 days. Yes, 117 days, option A. Now, whether the management is correct or not, how can we get to know that? For that, we have to see the industry standards. Now, if you look at the industry standard, the industry takes 90 days to collect the money from its debtors, whereas this company is taking how many days? This company is taking 117 days to collect the money from debtors. So, again, a problem. So the management is absolutely correct. Yes, the assertion of management is correct, sir, that this company is taking more time. That is why there is a cash crunch situation. Clear with this? Next part, third MCQ. What is the expense the company has to incur for earning 1 rupee of the revenue in the last year? What do you mean by expense here, sir? Which expense? You want to sell your product and earn a revenue. What is revenue? For 1 rupee of the revenue, revenue means the sales. To generate this those sales, what is the expenditure that you have to incur? What will be that expenditure called, sir? That expenditure is nothing but your operating, what? Operating cost. That will be your operating cost. That is, what is the cost incurred in the making of the product? What is the cost incurred in the selling of the product to generate that 1 rupee of sales? Right? And what will be the operating cost here? The operating cost here, if you look at here, it will be your COGS plus your admin expenses plus your selling and distribution expenses, or I can say COGS plus your operating expenses. Non-operating expenses, non-operating income we will not take. Why, sir? Non-operating is, that is not related to the operations. What we are saying here is that if you are manufacturing this jacket, to manufacture this jacket, to sell that jacket and earn a revenue, what are the routine expenses, the business expenses that you will have to incur, right? So it will be your COGS. How will you calculate this? This will be calculated as COGS plus your operating expenses divided by sales. Now the COGS is given to you, that is 76 lakh 40,000 plus operating expenses of 29 lakh 10,000 to generate a sales of 1 crore 25 lakhs. Right, so this will come to 0.844. This will be the expense to generate a revenue of 1 rupee. The expense to be incurred is 0.844. I hope this is clear. Right, one more thing here that you have to be careful with is what the difference between operating cost and operating expenses. Be very careful with this thing. Operating cost means COGS plus the operating expenses. The operating expenses means the admin overheads, your selling and distribution overheads, only that part. Clear? Now, next one. What is the projected net working capital of the company? Net working capital, sir. How we can find out? For net working capital, what you need? You need the value of inventory, you need the value of debtors, you need the value of creditors, you need the value of cash, isn't it? So from there you can find out your working capital. Yes, sir. Let's try to find out. Now, see here, what is the projected net working capital? Projected net working capital means we are talking about the next year. That means now we are going to focus on this particular part, the next year projections. Let's talk about inventory. Inventory says the inventory, closing inventory will be 70% of the opening inventory. Now next year, what will be the opening inventory? Next year opening inventory will be this year's closing inventory. This will become the opening for next year, isn't it? So can we calculate for working capital what we will take here now? Let's talk about the working capital now. How we can estimate working capital. So for working capital, what I am going to take is, the first part I will take is inventory. See, for working capital, we take current assets. In the current assets, we have to take the closing values itself, right? So closing inventory is what? It is given that inventory is 70% of opening inventory. So what will be your opening inventory? That will be closing of the previous year, right? And previous year values are given to you. That is 38 lakh 60,000. So 70% of 38 lakh 60,000, 70% of it will come to wait, 38 lakh 60,000, okay. 38 lakh 60,000, 70% will be 27 lakh 2,000. Right, it will be 27 lakh 2,000. This will be the 70%. Fine, sir. Another thing, read the question very carefully. What is given here? They say the cash is going to remain same. The cash balance is assumed to remain same. So what is the cash balance here? That is 2 lakh 30,000. So cash balance will remain same. That is 2 lakh 30,000. Now, what about the debtors? How can you find out the debtors, sir? What is given regarding the debtors? Debtors turnover is given, that is 100 days. What is debtors turnover? That is debtors divided by sales multiplied by 365 is equal to 100. Now the problem here is, do you have the sales? For debtors calculation, debtors are not there. Do you have the sales for the next year? Sir, we have 1 crore 25 lakh. Sir, 1 crore 25 lakh is existing year. Do you have it for the next year? The sales are not there for the next year. How can you do it, sir? Think about it. Can you use net profit ratio? Can you use the gross profit ratio or something else? Something that you can use for that? Anything? We cannot use net profit ratio. We cannot use gross profit ratio. We cannot use long term to debt ratio. We cannot use creditors turnover ratio. Nothing. The only thing that we'll use here is equity share capital to reserves. Sir, how can we use that? How can we use that? Equity share capital to reserves is equal to 1. What does it mean? It means that your equity share capital will be equal to your reserves. Equity share capital divided by reserves is equal to 1. That means your equity share capital will be equal to your reserves. Okay, I'll write it here. The next part I'll write it here. What I'm saying is, I'm saying that your equity share capital is equal to your reserves, isn't it? Now what will be the value? See here, if you look at equity share capital, will there be any change in the equity share capital? Any information regarding this, that equity share capital is going to change? Is there any information regarding this? Not at all. There is no information that equity share capital is going to change. So that means my equity share capital and reserves will be 30 lakhs each, isn't it? 30 lakhs each. Now look at the another thing. What are your existing reserves? Existing reserves are 18 lakh. Your existing reserves are 18 lakh. Now you are saying your reserves will be 30 lakhs. So if I subtract from here my existing reserves, if from here I subtract my existing reserves of 18 lakhs, why the reserves are increasing, sir? Why the reserves are have increased by 12 lakh? This 12 lakh is what? The profit for the current year. This becomes my net profit. Right? This becomes my net profit. Your existing reserves are 18 lakh. Now next year you are saying that the reserves will be equal to share capital. The reserves will be 30 lakhs. Now why will the reserves be 30 lakhs, sir? Why? Because there is a 12 lakh of net profit that you have earned in this. Now can you find out sales? Yes, sir. Now we can find out, because the net profit ratio we are having is 15%, right? So now sales we can calculate. Now we can calculate the sales will be what? The sales will be 12 lakhs of net profit divided by percentage of net profit, that is 15%, divided by 15%, that comes to 80 lakh rupees of sale. Right? Now your gross profit is given to you, that is 50%. So what will be your COGS? Your COGS will be 40 lakhs. Is that clear? Sales of 80 lakhs, COGS of 50%, GP of 50%, COGS of 40 lakhs. Now we can use this debtors turnover ratio, that is 100 days. Now we are going to use this. Now we will use this debtors turnover ratio, that is debtors divided by sales multiplied by 365 days, that is equal to 100 days. Now sales we know is 80 lakhs. So we can calculate debtors divided by sales of 80 lakhs multiplied by 365 is equal to 100. So from here you can calculate the value of your debtors, right? So 100 divided by 365 into 80 lakhs, that comes to 21 lakh 91,781. 21 lakh 91,781. You can round it off, no issues with that. Okay, so we have calculated the value of what? We have calculated the value of inventory here. We have calculated the value of cash here. We have calculated the value of debtors here. So what is left is creditors. Next value is creditors. Now he says the creditors turnover ratio based on COGS. Otherwise, what we write? Whenever the creditors turnover ratio is there, we say the creditors divided by purchases per day. But here, instead of purchases, what we are going to take is we are going to take the COGS because it is clearly mentioned in the question. That is again 100 days. Fine. So how we are going to do this? We are going to write here the creditors divided by COGS multiplied by 365 is equal to 100 days, right? So creditors will be, creditors is equal to 100 divided by 365 multiplied by COGS of 40 lakhs, right? So 100 divided by 365 multiplied by 40 lakhs, that comes to 10,95,890. 10,95,890. So this becomes your creditors. Now you have the current assets. Now you have the current liabilities. You can calculate your net working capital from the information. Sir, what about short-term investments and all? Sir, there is no information that is given regarding that. Right? So we have to find out the working capital from the information. From inventory is given, cash is given, debtors is given, creditors is given. That is the only information that you have. Right? So we'll take here your net working capital will be your inventory plus cash plus debtors minus creditors. Right? So your inventory and plus cash, inventory is 27 lakh 2000. Do it 27 lakh 2000 plus cash of 2 lakh 30,000 plus debtors of 21 lakh 91,781 minus creditors of 10 lakh 95,890. So that comes to 40 lakh 27,891. So this will be your net working capital. Now in this part, the most important point was this one. This one was the most important point, that how to find out that sales, and for that sales we needed a profit. Let's see. 40 lakh 27,891, that is option B. Clear with this? Coming to the last part, what is the projected long-term debt for the company? How can you find out the long-term debt? Now, long-term debt to equity is given to 0.5. So using that, we can say long-term debt divided by equity is equal to 0.5. Clear with this? What is equity now? Equity means equity share capital plus reserves and surplus. So long-term debt will be what? Divided by 30 lakhs of equity share capital plus 30 lakhs of reserves. Now they are saying equity is equal to reserves equal to 0.5. So long-term debt will be 0.5 multiplied by 60 lakhs. So that will be equal to your 30 lakhs of long-term debt. Clear? A very good case study, sir. Can this type of a case study be asked in the examination? Yes, definitely this type of a case study can be asked in the examination. And the interesting part here is that they have mixed two chapters. They have taken the ratio analysis and they have taken the working capital also. Yes, this type of a case study they can definitely ask in the examination. So with this, we are done with the case study of ratio analysis, a very important case study. After this part, please go through this case study once again, go through with all the solutions once again. I'll show here ITR calculated, ITR in days calculated, then we have calculated our average collection period, then we have calculated the working capital. For working capital, inventory, cash was same, and for the debtors we required the sales. For sales we required the net profit, so we calculated the net profit first as a difference between the existing reserves and the new reserves, right? So this is debtors, this is creditors calculation, and finally the net working capital. I hope this part is clear to all of you, right? And this was the last part, that is related to the long-term debt to equity, that is given as 0.5, right? So with this we are done with the case study of ratio analysis.